Hello, this is Kurt and Cameron Cambier with our 2022 wrap-up and 2023 market outlook. I want to remind people past performance is no guarantee of future results and markets do fluctuate. Boy, what a year 2022 was, wasn't it? It was a midterm election year. Those are usually the toughest years, but this one really had a doozy into it because the Federal Reserve was raising interest rates and the market didn't like that very much, and the economy seemed to be a little bit hesitant in those areas. So it was the worst year in the market since 2008, so that's a 14-year period. In the 60-40 stock and bond allocation, it's the second worst year ever. In 2022 was the worst year in U.S. Treasuries. It was a difficult second worst year ever in the NASDAQ and third worst year, I believe, in the S&P 500. So tough time period. No matter what you did, a lot of times you do diversification and allocation to go to stocks and bonds, and sometimes when stocks goes down, bonds would hold up. But bonds don't do very well in an inflationary environment and an interest rate increasing environment, at least most bonds. So we're going to go a little bit about that recap in 22, but we're going to go more into 23. And if you remember, one of the great investors of all time, Colin Davis, had said, you make most of your money in a bear market, you just don't realize it at the time. What did he mean by that? He meant that if you stay true to your long-term investment plans, and remember, money and time go together. If you need money in the short run, you need to have short bonds or maybe cash. Midterm, maybe you have a broadly allocated portfolio in small caps, mid caps, different types of bonds, international stocks. And then long term, you can have, maybe that's 5 or 10 years, you can have more of an pure equity position in order to go forward. Now, one of the things that's going to be different for everybody in this environment is that for 20 years, we didn't have inflation, or maybe even longer than that, 30 years, any real aspect of inflation. I was really young when we had it, when inflation was the last time it reared its ugly head. And we're going to have inflation, I think, going forward. I don't think we're going to have out of control inflation, but I think we're going to have more inflation than we're used to in the past, and that's going to affect really how we look at the returns and how we allocate. So one of the first things will be a little bit of a recap of one of the last videos we did last year, and is this. And this is the midterm election years. It says, in the midterms, a deeper corrections but stronger recoveries. So what happens is midterm years tend to be the worst years. We've said that before, and this one was certainly no exception. What happens is, we got to look down here, but what happens after a midterm election year? It says the S&P 500 has not declined in the 12 months following a midterm election since 1946, and the average S&P 500 has been up an average of 32% 1 year from the midterm bottom. Now, that's not the midterm year end, that's the midterm bottom. So what that means is we bottomed last year twice, once in June and once in September. And so September would be the midterm year bottom. So statistically, that's the case. Another statistical issue is that when the high yield junk bond market goes down and has a rough year, it's never had 2 negative years in a row. And when it does do that in the recovery year, the S&P 500 is up an average of 22%. When the market's up the first 5 days of January in that particular year, the market actually is up 26% on average. Now, no guarantee that's going to happen here. I think the Federal Reserve is getting close to being done raising interest rates. When that happens, the market will gain confidence. We'll go forward from there. The risk is if the Federal Reserve goes too far. Now, they were late going to the party. They may be late leaving the party, but it won't last long. So the fact of the matter is, people always tell me that maybe we haven't seen this macro environment before where we had a conflict with Russia, like Russia and Ukraine. Well, we did in 1982. Brezhnev died, and we're in a cold nuclear arms race with Russia. Market went to a bear market correction. Keep in mind, a bear market correction is a 20% plus correction. Went to that type of correction, and then market recovered 12 months later. What happened with, and that was a midterm year, what happened with that, market was actually up 58% the year after 1982. Now, I'm not saying it's going up 58%. I'm not saying it's going up 32%. I'm not saying it's going up 26%. I'm merely reporting history to you. The next one we talked about as well, the next slide that is coming here shortly, is this one. It's bear market recovery. Now, we've used this a lot. Now, bear market recovery, once again, a bear market's a 20% correction. This is all the bear markets since 1962. There's 62, 66, 70, 80s, and 2000s going forward. What happens 12 months after a bear market recovery? Well, the average upside is 44% 1 year later. Markets tend to recover very quickly from those oversold positions that often take place, and much of the market today, not all of it, we could say is oversold. 3 years out, it averages 16.58% a year, and 5 years out, 14.13% a year, and then 10 years out, more closer to its 9-10% long-term average. So I suspect the market's going to behave fairly similar to that once we get that momentum going forward. So the next slide that we're going to show really is the midterm election quarterly returns, and this is very interesting. Now, we were in our previous videos, we said there would be a tough year last year. You would earn your return, and you would earn your losses, actually. You're going to earn your long-term return, and that's really what we have to keep in mind. This short-term stuff really doesn't matter, and Cameron will touch on that with some quotes from Warren Buffett and stuff when he gets his turn to step to the plate here. But when we look at that, usually the markets after a midterm rally after a midterm, especially when there's gridlock. And it did rally a little bit, believe it or not. The quarter of this last year, markets were up. And we did have a very mini Santa Claus rally. It was a very, very tiny one, but it was a Santa Claus rally that took place. Not as much as we had hoped and not as much as we had wanted. As of the date of this video, which is mid-January, being put this together, the market had moved nicely early this year on the upside. We'll see if that trend continues. However, keeping in mind, the quarterly return after midterm, quarter one after midterm election year, on a non-midterm year is 1%. In a year after a midterm election period is actually 8.2%, and that goes all the way back to 1950. So all we know is the most dangerous words in the investment world, as Sir John Templeton once said, is this time it's different. And it's never really different. It may seem different. The media may tell us it's different. We may feel it's different. But in reality is if these are the cases, then this is some of the things or expectations or probabilities, not guarantees, that we should expect. So the next video that comes out is really what does the market returns look like in non-election years and in election years altogether. So if we look here, these are the election years. Markets do maybe about a 8% overall average return in election years. Those are all election years over time. But the market itself in non-election years actually goes almost above 14% is the average annual return. And that's how you put that 8 and the 14 together, and you get that long-term 9.5%, 10% return that the market seems to have over long durations of time of return. So we just went through a midterm election year. You lived through it. It was a situation where if you didn't need your money, you should stay allocated. Because we know coming out of those election years, we have a period of time when markets tend to outperform their averages. And I think that's what we're going to see here with this type of return. And once again, no guarantee, but that one goes back to 1950. That's a 70-year time period, pretty strong data points. So what happens is in midterm election inter-year pullbacks. These are midterm election year inter-year pullbacks. And this goes back a long time, all the way back to 1950. And you can see what happened in this midterm year is not uncommon. Once again, I've said that over and over and over and over again. But these are the election pullbacks. And you can see there's been some pretty big ones. 2022 had a pullback of 24%, 24.5% last year. 19.14 in 18, 15% here, 33 in 2002, 35 in 1974, 25% in 1970. You can see some of the pullbacks in 1962, 26%. So we've had some of these big pullbacks. What's happened after those pullbacks? 12 months later, what happens? Is it doom and gloom forever? It's not. It's opportunistic. The average upside is 37.2% 1 year after a midterm election pullback, going back to 1950. Now, we showed one earlier, that was 1946. So we're just using different databases and data times to come to the same results that says the markets tend to rally fairly significantly. Past performance, no guarantee of future results. So the next thing we go to is we talk about, is there going to be a recession? I don't know. We might be in one right now. I don't know. It'd be pretty hard to really say that we're in a recession. We're in an environment where we have such a strong labor market. But, sometimes that happens. But we're not talking about, in all likelihood, a 2008, a 2002 type of a recession. Recessions can be quite mild. The technical definition is 2 quarters of declining GDP growth. And we kind of already seen that already, so we may be working through that. But how long does it take for a market to recover from an average of a recession end? And the average length in months is right at about 4.5, 5 months. So we're not talking about a long duration of time. So when the recession either is at an end, and markets tend to move before a recession ends, so in that time period, you may be looking at a quarter plus a month for the market to respond back, going back a long time period over time. This chart takes us back all the way to 1945. So once again, statistically and historically, we know what takes place. This last chart, this really talks a little bit about inflation. Inflation is something we haven't had for really 50 years in this whole environment. So with this inflationary period that we're having, I remember inflation having grown up as a kid, as a teenager, and in my just early college years getting out. Inflation was kind of similar to what we've had right now, and in fact, it was actually worse. But some people like my son Cameron, who we've all gotten to know, you've all gotten to know quite well. He's never seen it before. I think inflation is probably here to stay, but very moderate inflation. And the truth be told, the government wants moderate inflation because it increases asset prices, it increases wealth. When wealth goes up, people tend to vote for the party in charge, and that's number one, because they feel better about themselves and about what the assets they own. But 2, the tax base can go up because who owns the assets? Well, the best growing assets with inflation historically have been stocks, number 1, and real estate, number 2, over time. And so what happens with that is that those assets go up, there's a bigger base for them to tax or to collect their taxable dollars. And let's face it, taxes are probably going to be an issue for many years to come. So if we look at this base here, we have inflation. That's the gray bar with inflation. If we go up here, we have long-term government bonds, which a $1 invested in 1926 would be worth $163 today. If you go through, without going through all this stuff, the S&P 500 index itself, the stock market, $1 invested in 1926 would be worth $14,000 today, as compared to $163 in long-term government bonds. So it's very, very clear, while it's somewhat uncomfortable in the near term with the volatility in stocks. It did not surprise us that it was there. We had thought we'd get a little bit better recovery, and I think it didn't happen because I think the Federal Reserve is a little bit late to the party, and I think they're going to maybe stay a little bit late. But once this clears itself out, we should have that great season of returns that can come. And I think the best way to look at the stock market is in the seasons of time. We're in winter right now. In fact, they're predicting a storm coming in tomorrow and the next day. And when that happens, that's winter. Winter tends to be cold, leaves fall off the trees, nothing's growing in the garden. It tends to be a little bit like a recession or a market pullback, a market decline. But then comes the spring. Things sprout, here comes the flowers, the summer. Spring goes to summer, summer goes to fall, and we go through that process again. And that's really quite true with investments. Investments tend to have that seasonality, but they also tend to have that pattern. And I've always referred to that as the Wall Street waltz. Markets decline for a year, and they go up generally for 4 or 5 years, and on the back side of that. So once we get past this time period, history, as I've shown here on these slides, gives us that opportunity to see some very positive returns. So stay the course. Don't let your emotions override your logic and override the successes and knowledge of history. So the impressive weight of historical evidence, as Jeremy Siegel once said, is what makes stocks an attractive long-term investment. So I'm going to be done there. I'm going to allow Cameron to come up and he'll take over the next part of this. Really appreciate your time, and always give us a call at 303-271-1067 is my direct line, or 303-584-1161 to hit the team and to get a hold of Cameron. And we'd love to meet with you. We'd love to meet with any of your friends, and we would love to answer any questions you have. Anyway, thank you, and let's have a great 2023.
Well, hi there, guys. Happy New Year to you. I hope everybody out there had a wonderful holiday season with your families. If you were traveling, I hope you didn't have any issues. Obviously, the debacle with Southwest here in Denver. My wife and I were actually supposed to go to Oklahoma the Friday before Christmas, and then we had that snow and cold come through, and we ended up getting rebooked to Christmas morning at 6:30, which wasn't fun getting up that early on Christmas, but we ended up getting to Oklahoma fine, getting back fine, so some others certainly had it worse. But, you know, guys, I've been doing a lot of thinking about last year, and my father just kind of went over a lot of the statistical things about midterm election years, the year after, and I'm really going to try to keep it more on a fundamental level. And, you know, when I think about last year, there's really one word that comes to mind for me, and that word is surprise. And not in the sense that my father and I were surprised about what happened last year. It did go a little bit deeper than both of us anticipated, but actually, if you go back and watch our videos from the beginning of last year, or even the video before last year even took place, my father said, hey, you know what? I expect this year to be a really tough year. I expect it to be volatile a good part of the year. Now, is that because my dad is an old wise guy and can see the future? He's got that crystal ball? No, of course not. But my dad's been in the industry long enough. He sees trends. And you guys know my father and I looking back over history and seeing what it has to say. And if you look back, history says, yeah, midterm election years, they typically are a bad year. And the year after a midterm election year, the year we're in now, are typically a good year. Now, does that mean it plays out exactly the same way every time? No, of course not. Past performance is never an indication of future results. But I say the word surprise because I think a lot of investors are often surprised when we get these large downturns. And really, they shouldn't be, because it's just simply a part of the game. And I'm going to walk you through this chart behind us, which talks about history of market corrections, right? My father and I like studying history, and what history tells us is about 3 times a year we average a 5% or more type of decline in the market. We average a 10% or more about every 16 months, a 15% or more about every 3 years, and a 20% or more about every 5.33 years, right? My dad talked a little bit about that when he was chatting with you guys, right? The Wall Street waltz. Markets go up for 5 years, they go back a year. Markets go up for 5 years, they go back a year. So we know that these type of corrections take place. And you know what? It's not a matter of if we're going to get another one. It's a matter of when, because we will definitely get one again. And it's often in times like these where investors make their biggest mistakes, are in down markets, right? They turn temporary losses into permanent ones. I talked a little bit about that on the last video. They try to time the market. They lose sight of their financial plan. They get emotional with their money. And I understand that, guys, right? We're human. It's an easy thing to do, but you really got to avoid that when you can. And that's really my father and I's primary job, right? Is to be that wall between yourself and your emotions. And, you know, when I think about it on more of a kind of a human level, you know, like way back in the day when we first got our survival instincts, well, we had to be really ready for what was right around the next corner, right? Because way back in the day, the thing that was right around the next corner was probably something big enough to eat us, right? And I know still living in Colorado, sometimes that can still be the case. I don't know if you guys ended up seeing former Denver Bronco Derek Wolfe kill that mountain lion up in the mountains here recently. That was a big cat. We got some big cats out here in Colorado, and I'm actually a big cat fan. Not a big cat fan, but I like cats, but certainly not ones that are that big and have the potential to eat me. But the point I'm trying to get at is that kind of survival instinct doesn't really do well when it comes to investing, right? Because you can't always worry about what's right around the next corner, because investing is a long-term game, especially if you're going to own individual stocks. You guys know my father and I are huge fans of individual stocks, and individual stocks are always considered long-term investments. And why is that? Well, because it's not uncommon for them to drop 10, 15, 20% below their previous highs in a short time period, right? We saw that last year. So I think we really need to kind of take a step back further when we get these downturns, and we got to think to ourselves and say, hey, okay, is this just a temporary blip? maybe even an opportunity to buy more? Or is this truly a risk to truly a permanent potential risk to our capital? So folks, you really got to try to work hard to have a long-term perspective about things. So instead of worrying about what's going to happen next week or next month, next quarter, maybe even the next year, we need to start thinking about, hey, okay, let's think about the next 5 to 10 years. Is what's going on now really going to have such a big impact down the line in 5 to 10 years? Because another thing I think we do as humans is we tend to magnify the moment that we're in, right? Like I'm a big sports fan. I like all the Denver teams, and the Broncos, if they have a playoff game, man, it feels like it's the biggest game of all time. And it's like, well, it's probably not. It just feels big because we're in the moment, right? But it feels that way whenever we are in a bear market, in a negative market, right? Oh my gosh, I don't know if anything's ever been this bad. Or when we're in a roaring bull market, geez, I don't even know if we've ever seen a time period like this. It's amazing, but neither of which is true. You really got to stay even keeled through the whole process. And the reason I wanted to take it on more of a fundamental level today, guys, is the financial industry and the investment industry, just like any industry. It's extremely dense. There's a lot to know. It can be very technical. Trust me, my brain is still hurting from all the material I had to study for my Series 7 and Series 66. I enjoyed studying it, believe it or not, but it was very technical, very challenging. But really on the surface, something I've learned over my 5 years of working with my father, which by the way, I did hit my 5-year anniversary working with him last November. And yes, my old man is still alive. I'm still alive. We haven't managed to strangle each other to death yet. But one thing I've learned is people make investing too complicated, right? People think you have to be this really intelligent person to be a really good investor, and that's just simply not the case. And I'm going to talk about a quote that just really backs that up from one of the most legendary investors of all time. We all know his name. I often reference him on the radio, and we speak about him quite often in our videos as well. But it's Warren Buffett. And he said the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. So what is he saying there? He says, what we were talking about earlier, don't get emotional. Don't get overconfident, right? Don't get too high, don't get too low. Stay even keeled, have a long-term perspective. Don't worry about these short-term drops, and everything will work out in the long run, right? The biggest enemy to investors, and I spoke about this on Ross's show, right? Because I was watching CNBC, and they had a bunch of talking pinheads on there, and they're talking about, hey, what's the biggest risk to investors this year? Is it inflation? Is it the Russia and Ukraine conflict? And I always thought to myself, it's the same answer every year. It doesn't matter what's going on in the world. The biggest risk to investors is themselves, right? And it's because of the things I talked about a little bit earlier, right? They make those emotional mistakes when the market goes down, and they make emotional mistakes when it goes up as well, right? When the market's going up, they think, right? They think get overconfident. They say, oh my gosh, they magnify the moment. I don't think we've ever seen a time period like this. This is a great time to get in. And that's usually actually the worst time to get in, is when the market's kind of already at its peak. So guys, that's really all I had for you today. If you're a client, we really appreciate your trust and confidence. We appreciate you watching this video. And if you're not, and maybe if you're thinking to yourself, hey, you know what? I could really use somebody to be that wall between myself and my emotions. I encourage you to give us a call. Guys, whether you're a client or not a client, if you have any questions, if you'd like to learn a little bit more about us and our unique take and look on investing, please give us a call. That number is 303-584-1161. That's our main office number. Or you can go to the website as well, which has all our contact information on there. The website is kurtcambier.com. That's KURTCAMBIER.com. And guys, again, past performance is no indication of future results, but I hope we have a very wonderful and prosperous 2023, and we are always here to help for whatever you guys need. Again, thank you very much, and Happy New Year.